Hey guys, I have a really great trading strategy to show you that I personally use in my Roth IRA, my personal brokerage account, and in my cryptocurrency trading accounts. I use this strategy on pretty much everything. I am happy with how it performs. In many cases, I can beat the market with it, and I believe it is simple enough that an inexperienced beginning investor should be able to use it in their account. I also have an indicator on TradingView that automates the strategy and does all of the math for me and shows me what prices to buy at, and all I have to do is submit the orders in my Roth IRA, or in some cases I like to automate the strategy and have the orders submit automatically without any human intervention required. If you like what you see here, please like and subscribe, and also visit my Discord community. That's the fastest way to reach to me. And what's great about Discord communities is that you will usually find very nice people in there who are happy to help whenever you have a question or want someone to bounce investing ideas off of. So, in this video, I'm going to show you a method of risk management that allows you to win every trade that you take. Alright, let's get into it. So, your typical day trader will do something like this. Uh, A beginning day trader will usually put a large arbitrary amount of money into every trade and won't have any exit strategy in place. They'll just buy and wait and see what happens, and then they will sell at an arbitrary random point in time because they need the money for another trade, or maybe they saw some negative news come out about interest rates or whatever, right? Trading this way is random, it's not sustainable, and it will not make you rich unless you are very lucky and just happen to come across a needle in a haystack. So, your typical professional day trader will do something else. They will constantly watch the market, searching charts on various stocks, crypto coins, forex pairs, etc., looking for that perfect setup. A setup is just a nice, clean looking graph where several indicators are lining up the way you want and forming an entry signal. Then you will go either long or short, right? And the first thing you'll do is set your stop loss. Let's say we set it here. And then next you'll set your profit target, right? And let's say we set it here, for example. You'll usually set it a little bit farther away than your stop loss, and that'll give you a healthy R&R. If your R&R is 1, your risk reward ratio, see this number right here changing. That's your R&R. If your R&R is 1, then over the course of hundreds or thousands of trades, then you need to win at least 50% of your trades in order to break even. If your R&R is 2, right? If your R&R is 2, then in that case you only need to win 33% of your trades in order to break even. So your typical professional day trader will find a good entry signal, find a healthy, compatible R&R value, and hopefully over time you will win more money than you lose. So, one drawback to this method is that drawdown can be unpredictable. Sometimes the market will shift slightly and start behaving differently. Your entry signal might not be behaving the way you want. It might not be giving you good results. You might have a random long string of losing trades, and it can cause you to doubt your entry signal, causing you to override or even abandon your strategy entirely in the middle of your drawdown period. For those reasons, I personally don't like using stop losses. I hate selling at a loss, and I hate wondering if my entry signal is working or going to keep working. It's a useful tool for managing risk, but it's just not the tool that I like to use. So I'm going to show you an alternative to that system. Here's what I prefer to do instead to guarantee that I never actually lose any trades. Let's see. Where do I want to do this? Let's use this as an example. So if we are right here and I say that I want to enter the market, I will not wait for an entry signal. I will just submit several limit orders below the current price. Okay? This is what I do. These are limit orders below the current price right here. Okay? Now, if the price goes up and never fills the limit orders, then I will overwrite my limit orders. I will delete them. Let's see here. I will delete the limit orders and I will create new ones below the current price. Okay? So all I did was move them up. I might have written more of them, but you get the point. So this is no longer here. Now we're right here in time because the price went up, so I decided to overwrite my layers. Then, if the price goes down and fills my first layer, then I'll set a sell order at this point on this candle. I'll get an alert that tells me, okay, your limit order filled, submit your sell order. So I'll submit a sell order wherever. Let's say it's up here, right? And then price continues to go down and it fills this layer. So then my average entry cost has now gone from here down to somewhere in this region, right? Because I averaged down. So my average cost per Ethereum coin has gone down. So that means that my take profit price can now move down as well. So I'll move that down, right? Because that's a method of risk management, to move the take profit down as your average entry cost moves down. So then price right here, it crosses another layer, so then I'll average down again right here, right? And if my volume increases as I go down, if this layer has a small order size, and if this has a larger order size, and if this has an even larger order size, then that will let me be able to average down faster. I hope that makes sense. If each order is the same size, then you'll get a diminishing result of your averaging down. So doing it this way, it lets me average down farther. So then this is my take profit line. It goes across this way, and then right here we fill this layer, so then I average down again, right? And it's more dramatic now because my layers are getting farther apart and they're getting bigger, right? So let's say it's down here, and then I might take profit here, or I might take profit, let's see here. Oh, well, the line went away, but you get the point. I take profit over here probably. So the placement of each of the layers will be pre-planned beforehand. They're not random, right? They are systematically placed based on backtesting. All right, so I will show you right now how I backtest it. So right here, I have what's called the cash DCA algorithm right here. Cash DCA algorithm by parabolic value. This is an indicator on TradingView, okay? And this indicator runs that exact strategy that I just described to you. And what's loaded up right now is the default settings. And you'll notice that, so this line here is the take profit line, right? And this whole green shaded area is just the in profit region, right? So at the bottom is the break even line, and then anything above the break even line is green, and then you have your take profit line. And you'll notice that once it takes profit, it actually resets and starts over and starts a new trade every single time on repeat. Rinse and repeat, rinse and repeat. It just continues to do that over and over and over again, okay? So what's loaded up now is the default settings, and here's the indicator. Right here in the bottom right is a live balance. So what it's showing now is $1,066. And that will increase as the trades fill, right? Right here is the open orders, right? Those are the limit orders that have not been filled yet. It just went through 7 of them, and it's going to bounce eventually and take profit again. So we'll look at the settings again. What we're looking at here is the starting balance, and there it took profit. Starting balance, the number of layers that you want to use. You can use up to 12. There's a few other settings, but okay, I'll describe it. So if price goes up 3%, then it will overwrite the layer placements. So that's what this setting is. This is the start date of the indicator, and here we have the layer placements. So if I change layer 4's placement to 12, then you'll see that layer 4 will move down. See? So move that back, I think it was at 9. And you'll notice that every time you change a setting, so change this to 11, every time you change a setting, your end result will change. Did it change? I don't know if it changed. If I'll set this to 23, there we go. There's your change. So every setting has an effect on the backtest. Here you have your order sizes. So the size of each trade, each layer. So layer 5 might be, right here we have layer 5 set to 17% of the money that's available to the strategy. Or let's say for example that you give this strategy access to one trading account, then this would be 17% of the money in the account. Okay. Down here is the take profit percentage. On each layer you can change the take profit percentage however you want. So maybe if you have a small dip that only fills layer 2, layers 1 and 2, then maybe you'll want your take profit percentage to be 7%. But if you have a large dip that goes all the way down through 6 or 7 of your layers, then maybe you only want your take profit percentage to be 3% based on your average entry cost. If I look at the performance of this indicator, if I remove replay mode and I go to current day, it's showing that I would be up 90%. Going back to October of 2020, I would be up 90% if I had been running this indicator from that day all the way to today. One thing you might be wondering is, what if price just crashes down through all of your layers and continues to go down and you're stuck holding a red bag for a long time? Well, the best way to prevent that from happening is by choosing better settings, okay? Choosing safer settings that have larger order volumes down in lower layers, okay? So in order to make this strategy more safe and less aggressive, you would want these, you would want to use more layers, and you'd want your lower layers to be at lower prices. So right now the default settings go down to a 35% dip. Let's say maybe I want to cover a 60% dip. Maybe I would add a layer that says that's at 48%, maybe a layer at 55%, maybe a layer at 65%, okay? Your order volume, to be more safe, should start at smaller numbers and end with larger numbers. And then your take profit percentage should be lower on the lower layers. That makes it safer. Or maybe just lower overall. everywhere. That would be even safer and less aggressive. Now, let's say it's too late and you're already holding a red bag because you put in bad settings. Okay, so now what you should do is either one, just wait it out, or two, reserve a lump of cash on the side that allows you to average down manually. So if the strategy does not cover large dips, then you should have a lump of cash on the side so that you can manually deal with the large dip yourself. So, a stop loss is one method of managing risk in a trade. Averaging down like this is an alternative method of managing risk. You have to manage your risk somehow, whether it be with stop losses, averaging down, hedging your trades. All of those work, and all of them have unique benefits and downsides too. I like using this method because it's pretty simple and I don't have to ever sell at a loss, and that just feels good, right? And I also don't have to deal with entry signals. Um, I hate trying to figure out what entry signal is best in what market condition. It's all too complicated. This keeps it simple. Now, regarding the script that I showed you, if you like it and you'd like to try it out, the link is in the description. If you want to ask me questions, or if you need help using the indicators or following the strategy, please join my Discord community and chat with me there. The link is in the description. Also, this video is intended for entertainment purposes only. I am not a financial advisor.